let's continue looking at equity securities, but let's move to look in what happens when the company owns between 20 and 50%, which means it has significant influence over the company. In this case, we're going to elect to use the equity method. Keep in mind, when companies own that percentage of stock, they can elect a fair value option. But let's look at how the equity method is treated in accounting. So on January 1st, Porter Inc. bought 23% of the outstanding common stock of Lake Construction Company for $304 million in cash. At the date of acquisition of stock, Lake's net assets had a fair value of $920 million. That'll become important here in a few minutes. We'll discuss why this information is given to us. Their book value was $820 million. The difference was attributable to the fair value of Lake's buildings and its land exceeding book value, each accounting for one half of the difference. In other words, they're carrying these assets at $820 net. The fair value of them are $920. So when we purchase a company, it's based on the fair value of the company, and that would be the $920. Lake's net income for the year ending December 31st, year 1, was $152 million. During year 1, Lake declared and paid cash dividends of $31 million. The buildings have a remaining life of 10 years. Prepare all appropriate journal entries related to the investment during year 1, assuming Porter accounts for the investments by the equity method. When we use the equity method, it's very similar to as if it's a subsidiary of our company. Everything that happens within the company as far as income, dividends, valuation of assets is actually sort of changed on our books. So let's look at this, and it's going to be totally different from what we just did with the fair value in some respects. However, the initial entry is the same no matter what. So let's record on January 1st the purchase. So we actually bought the common shares, so we're going to hit investment in stock, or I'm going to put Lake stock just so we can remember what company we're working with. And we're going to put that in at the purchase price, $304 million. And then we're going to record how we paid for it. So we're going to reduce our cash because that's what we use to actually pay for this investment. Now, we're not worried about fair value of the of the stock. What we're worried about is how much income the company we've invested in earns. So how much income did Lake Construction have, and did they pay out any dividends? And how that reacts or works with our actual company here. So first, let's look at net income because they told us that first. Lake's net income for the year was $152 million. Since we treat this sort of like a subsidiary, as they earn income, we recognize the percentage of income in theory that is ours, since we are a 23% owner. So on December 31st, when they report this income, we're going to go in and alter our investment in the stock based on the change in the income. So they had $152 million in income. That's a positive number. So our investment in Lake stock will actually go up based on our percentage of that. Well, what does that mean? Well, the company as a whole made $152 million. We, in essence, own 23% of that because we're 23% owner. So we're going to multiply that $152 million by the 23% that is theoretically ours and put it on our books at 34.96. Again, all these numbers are in millions. Because we are using the equity method, we have significant influence in the company in which we bought stock in. So as their income is reported, we will assume or record whatever portion of that income in theory that is ours. And then we're going to actually hit that to investment revenue, 34.96. And again, if they had a net loss, we would do the opposite. Okay, it would reduce our overall investment and we would show an investment loss there. But since they have income, we put it into and increase the value of our investment. It does not matter what the fair value of the stock is. What matters is our investment. All right. The next thing let's talk about is the dividends that the company paid out. Now, the dividends declared and paid were $31 million. So just like the fair value option, when dividends are paid out, we're going to receive cash. Now, in this case, they declared $31 million, but keep in mind only 23% of those actually belongs to us. So you're going to take out your calculators there and do our 31, multiply it by our 23%, and we end up with 7.13. So again, that's our percentage of the dividends. Now, we're not actually going to hit that as dividend revenue. Because remember, we've already recorded those dividends as part of our income in the net income. Because, think about it this way, when a company distributes dividends, they're distributing the earnings to the owners. So under the equity method, when they distribute the earnings to the owners, we receive the cash, but what happens is it reduces our overall investment because it reduces the equity of the company in which we are part owner in, 23% owner in this case. So it's a little bit different in the way we treat equity method. All right, and we'll discuss that a little bit more. Personally, I'm not a fan of the equity method. It really is not logical in my opinion because we're not consolidating, but it is the method that is in US GAAP. All right, so then the last thing, and this is where the fair value of our assets come into play. We do need one additional entry. So let's look at this purchase price. We paid $304 million for 23% of this company. Well, when we look at this company, the net assets of the company were only worth $920 million. So what does that mean to us? Well, if we went to value this company, we would take $920 million times 23%. In theory, that's the amount of this company that we actually purchased. So we paid $304 million, but if you multiply that out, we only received net assets of $211.60. You're like, wait, we paid $304 for something worth $211.60. Absolutely. So what does that mean? Well, if you take the 304 minus the 211.60, what you end up with there is 92.4. What that is considered is goodwill. Now, we're not going to record it as separate goodwill. It's already embedded in the investment in our company. But that is considered goodwill because we paid more for the value of the company than the net assets are worth. And that happens a lot in companies. There's other values there. But that's not the only thing we have to consider. Well, wait a minute. When we look at the book value of their assets, they're only carrying these assets at $820. So if we multiply these by 0.23, if we look at the company we own 23% of, they're carrying these assets at $188.60. Now that's quite a bit more, or less, excuse me, than the 211, to the tune of about 23 million less. Okay, and again, that happens. You buy land and you carry it at historical cost. Land values a lot of times increase, so you have fair value assets that are not reflected as fair value on your balance sheet. So what we do with this is we paid that portion for it. Now we have to know what creates that additional 23, and there was two things. There was land that created 11.5 of it, and there was a building that contributed 11.5. So what we have to adjust for is what we call the additional depreciation that they would have taken if their assets were valued at fair value, what we theoretically purchased them for. When this happens, we must account for the additional depreciation expense Lakes would take if they paid fair value today for the asset. In other words, net income would be less given the value paid for the asset. Now, one thing about it, land doesn't depreciate, so we don't have to worry about the portion that's attributed to land. No matter what, land would not impact the income statement as far as that goes because land is a non-depreciable asset. However, the building would. So to find that additional depreciation, we're going to take the 11.50 and we're going to divide that by the 10-year life that it states. It said buildings have a remaining life of 10 years. And when we do that, we get 1.15. So if Lake had the building valued appropriately on its balance sheet, what we paid for it, their net income would be 1.15 million less than was what was reported. In other words, they didn't make 152 million in that scenario. Okay? So we have to record that additional depreciation. And what we do in that case is their income would be less. So remember, we recognize 23% of 152. that 152 was too high because it was excluding depreciation. So we need to go in and basically remove that portion of depreciation from that revenue that we recorded prior. And then we're going to hit the investment in lake stock, 1.15. So that is another entry that is required as process if we pay more than the book value of the asset. And the fair value, if the fair value exceeds the book value of the assets that we're in theory purchasing 23% of. I know that's a little bit confusing, but we do have to take that into consideration. Now, we do nothing with the goodwill. You're like, well, wait a minute, 92.4 in goodwill. We would not touch that goodwill. Remember, goodwill is not depreciated, it's impaired. So if there's no impairment there, we don't have to worry about that. We wouldn't do anything with the goodwill. Only the assets that would depreciate that make up that difference. Okay? Now, a lot of times people ask, well, wait a minute, we're adding to and subtracting from the investment account. What happens if it hits zero or it goes negative? What happens if this company starts losing money and eventually we write off so much that our investment is really worthless? Well, one, you can't take the investment account negative. But under equity method, the investor only provides for additional losses and only recognizes the liability to the extent it's incurred legal obligations or make payments on the investee's behalf, which is typically not usual. So if I own 23% of stock, it's very rare that I'm going to have to pay off any of or make payments on behalf of lake construction. That's not the way stock typically works. So once it hits zero, we just stop. We don't record anything else. We just have a worthless asset on our books. If we do have other obligations, we may end up going into a liability position, but it's not likely. So this method of accounting is a sort of a strange method in my opinion, but it does exist in both U.S. GAAP and international IFRS. So therefore we do need to look at it and see. Now keep in mind we can elect a fair value option. So you can go with a fair value option. All right, so let's look at the last part of this question on your handout there, and it says to determine the amounts that would be reported by Porter, one on our balance sheet. Well, we would carry this position at 330.68. And again, all you have to do is follow the entries for the investment account. We started out at 304, then we added 34.96 for the portion of income. Then we took away 713 for the dividend, which reduced equity. Then we had to take out the additional depreciation the company would have recorded if the building were properly valued at the fair value. So when you do that, that leaves you with 330.68. That's the amount we would carry on our balance sheet. Again, under equity method, the fair value doesn't matter, which is sort of, I think, odd, but that's what we carry it at, 330.68. Now, investment revenue in the income statement. So what did we earn in the income statement? Well, in total, we had 33.81. Well, what does that come up? That is our portion of the income minus the additional depreciation that we hit against it. So 33.81 would have been the 23% of income, again, had that asset been valued properly. And then last, among investing activities in the statement of cash flow. So in other words, how would this show up in the statement of cash flow? And it would really be simply 304, and that is the purchase price. Remember, statement of cash flow only cares about the cash events. So the investing activity would show the purchase price. You're like, wait a minute, what about dividends? Well, remember, interest and dividend revenue, both of those actually show up in operating. So the 7.31 in cash received for the dividend would actually be an operating activity, not an investing activity. So we have to be careful with that. So the purchase price, the 304, that would be the investing portion of the cash flow. 7.13 would actually be part of operating.